Seth Klarman, he noted value investor, I don't need to introduce him, of the Bofors Group, in his annual letter to shareholders, reiterated his firm belief in value investing. The chief executive and asset manager of the group, which manages more than $40 billion for the uninitiated, let me tell you that, but grimaces on the underperformance of value equities in 2019, as also the last few years. So here's some things that Seth Klarman lays out in his letter, which I want to bring out for the benefit of our viewers. It was written a day before, so I'm bringing it to you now. For the factors that impacted the 2019 performance, Klarman says, one, the conservative positioning that they had, two, the continued underperformance of value equities, essentially for the US markets, but for world equities at large, I would presume, the persistency of a generally lackluster opportunity set, and a few mistakes that they made, which I think would be true for almost anybody who has underperformed in 2019. The interesting bit is he mentions, and I love this quote in the letter. It's an 8 or 9 page letter, but one of the things that he says, and says quite well, is he says that sometimes the market tells you one story, even as the performance of the underlying businesses tells you another. This is the case with many value equities today, essentially underlying the fact that even though the underlying business is looking very robust, the market tells you that it is not interested in value equities. So it's telling you a completely different story from what the business performance of some of these value stocks could be looking like. And he, of course, dates this back not just to 2019, as I said, but to a decade or more of underperformance of value equities. And he mentions the two indices, which is the Russell 1000 Value Index, which from 2007 on has given returns of about 6.6%, versus the Russell Growth Index, which 2007 on has given returns of about 11%. This is essentially from his letter, but certainly shows how value has not quite performed compared to growth. Now, on market learnings, again, something that he says impacts human behavior and therefore stock picking as well, that market cycles can last for a decade or more, but humans tend to experience time in much shorter intervals, which is why many investors don't quite reason well when they are going out and buy. And the worry that he has is that a lot of investors of the current times haven't quite experienced a long-term down cycle or a bear market, and that might come to bite them as and when these markets do turn. Speaking of when the markets could turn, he lays out a bit on the road ahead as well, on how to play the markets ahead. He's saying that extended valuations alone are not predictive of any kind of imminent collapse, because elevated multiples can be stretched further if the conditions remain generally benign. And I think by this, he's talking about the cash in the system or the money that is chasing risk assets and equities in general. And if that money flow stays behind, then elevated multiples can be stretched. He also weighs in on what could happen to the US elections outcome and thereby impact on equities, balancing his act. So he's saying that a second term for Donald Trump would potentially be even more volatile than his first term. But he says that in 2020, instead of Donald Trump, if a far left candidate is elected in the US, that would bring in a new and a different set of risks, because the policies would change quite dramatically from what Donald Trump has enacted. Maybe taxes go up, maybe populist measures come in, and all of those are something that the markets may not have contended with for the last 4 years. So both outcomes could have some volatility post the US election verdict is out later this year. He also weighs in on two very important parameters as I end this piece. One is sitting on cash. Now, I think in the letter he's mentioned that they are sitting on 31% cash at the end of December. But he's saying that sitting on cash may not be a completely unreasonable thing to do, considering what the markets are doing and his own approach to value investing. But he mentions that there is some issue with this as well, because sitting on cash would mean passing out or passing on the many compelling investment opportunities that are currently available in the markets. Because everything is not only not expensive, but in certain cases downright bargain price, quote unquote. He's clearly stating that at the current point of time, while it may be tempting to sit on cash, is so much of bargain available that investors might actually be better off putting that money to work in that market. And just to highlight the discrepancy between value and growth, and between value companies as well as overpriced companies, he dwells a bit on alternatives, unicorns, private equity, etc. So he's saying that the investor exuberance that is prevalent in the markets, according to him, is best illustrated by the robust fundraising environment for alternative investments. Private equity seems more attractive than it will likely prove to over a full cycle of boom and bust. Again, reiterating the fact that a lot of people haven't quite seen a full cycle of a boom and a bust, and therefore people might be caught napping as well. He does mention WeWork as a stark reminder of how quickly the lessons of prior financial bubbles can be forgotten, referring to the valuation multiples that WeWork had at a point of time in 2019 of 47 billion and how they quickly came down to about $8 billion. So very interesting note put out. Great read for anybody who's into investing and more so into value investing. So I urge you to go and read that. But if you don't have access to that, maybe try and just hear out the summary that I laid out for you right now. And of course, on almost all of the pieces that we bring to you on First Word or otherwise, do try and log into our website, bloombergquint.com, and try and read more about those.